Hey, good afternoon, ladies and gentlemen. Welcome back to this weekly market review. I have Mr. Gerald Wong back with me today for this week review. And a lot of things happened last week. Of course, the big news was the CME Fed announcement. And then the STI also sank 2.31% for the whole week, which largely gave up what we have gained last week. And it was a very tough week for the global markets. Anything to share, Gerald, on those happenings later on?
Yeah, so it was definitely a very significant week for the market. I think we saw the Fed announcement in terms of interest rates going up and staying there higher for longer. So that's something that I will share a bit more during today's weekly market review. But before that, some housekeeping things that I wanted to share. Today's sharing is for education and information purposes only. So while we are talking about individual stocks, it should not be taken to be financial advice in any way. If you find today's session helpful, do leave us a review on Google. You can scan the QR code or you can go to the URL that is seen here. And last but not least, do consider joining SIAS as a member for just $1 per month. And you can actually take part in the various programs that will be organized for you. Okay, so as Sunny mentioned earlier, the markets had a tough time in the past week. We saw the US indices actually falling in the range of 1.9 to 2.9%. And closer to home, the STI also fell by 2.3%. So what is actually driving this decline in the market over the past week? Okay, the most important event that investors were looking out for was the latest Federal Reserve meeting. A few things actually came through from the meeting that I will actually go through in more detail during this session. So first and foremost, we see that they kept the benchmark interest rate at 5.25 to 5.5%. So on the headline level, you might be thinking that, oh, actually that is a good news because they are effectively pausing on the interest rate hikes and we are not seeing interest rates go up further. Okay, so first and foremost, there's no change to the benchmark interest rate. It stays at 5.25 to 5.5%. So what is it that actually caused investors to be more concerned after the Fed meeting? Okay, so what actually came through, and that is the key message that would be helpful for all investors to be aware of, is that the Fed has signaled that interest rates will stay higher for a longer period of time. Okay, so first and foremost, there are no rate cuts expected this year. In fact, based on the projections of Fed officials, they are thinking that there could be one more rate hike over the course of this year. So this is definitely not something that investors are currently expecting. Once again, if you go back to the CME Fed Watch tool, which is something that we have discussed many times, what you see here is that currently investors are not expecting further interest rate hikes this year. Okay, so that is something that was a bit of a surprise to investors, that Fed officials are still projecting one further rate hike this year. The second key message, and that is the more important one, is that the pace of the rate cuts is slower than market expectations. Okay, so if you look at this chart here, effectively based on the market expectations, they are expecting that the Fed will start cutting interest rates by July 2024. And by the time we get to the end of next year, we'll get to a range of 4.75 to 5% from the current level, which is 5.25 to 5.5%. Okay, but what the Fed has actually put up in terms of its projections is that even by the end of next year, interest rates will still be at about 5.1%. Okay, so that is something that once again disappointed investors because of the fact that interest rates may stay higher for a longer period of time. Okay, so how did different markets actually react? I think first and foremost, we can look at what has this actually meant for the US government bond yields. Okay, so this is effectively a chart of the US 10-year government bond yield. We see that this chart actually goes back all the way to 2003. And what you see here is that over the last 2 years, there has been a very significant spike. And even in 2003, if you look at what has happened over the past few months, it has continued to move up, such that it is now at 4.4%. And the last time that we saw the 10-year US government bond yield at this level was actually all the way back in 2007. Okay, so now the US government bond yields are at a 16-year high. And that is something that investors are having very significant concerns about. And not only that, it is at a very high level, but expected to stay at such a high level for a longer period of time. Okay, so that is effectively what caused the market to correct in the past week. And we can see that in the Singapore market as well. In terms of the top gainers last week, we saw DFI Retail Group, Yangtze Shipbuilding, Emperador, Singtel, and Jardine Matheson, with gains of about 1% to 3.4%. Once again, is there any similarity to some of these names? We see that actually, say for the likes of Jardine Matheson, it is a stock that is quoted in USD, and also for like Yangtze Shipbuilding, they benefit from stronger USD versus the Chinese yuan. So effectively, with the higher US interest rates, the US dollar has strengthened, and these are names that are seen to be potential beneficiaries. We also see Singtel gaining 1.3%, and this is something that I will share a bit more of when we talk about the corporate news for the past week. In terms of the top losers, we see a number of names that are actually down quite significantly last week. We have got Mapletree Pan Asia Commercial Trust down 5.2% to a 52-week low. We have got a number of the property-related stocks, City Developments, Capital Corp, UOL, down about 4% each. So if you think about the commonality to all of them, once again, the concern is on the higher interest rates and how will that actually affect these property developers as well as REITs. So for example, for the REITs, the concern is whether they will face higher financing costs that will affect their distributions. And then if you think about the property developers, if the mortgage rates are higher, the concern is that whether that will affect their new sales pipeline. Okay, so a few key corporate news that we'll talk about. We have got actually Singtel. We saw that it is one of the top gainers for the past week. That's because they announced that private equity firm KKR will acquire a 20% stake in its regional data center business with an investment commitment of up to 1.1 billion. We have actually got SIA reporting the traffic volumes for August, which was actually down compared to the month of July. And last but not least, we have got SingPost raising the cost of the local standard regular mail by quite a significant amount to be able to offset the escalating cost of maintaining the postal service. Okay, so we'll start with Singtel since it was actually one of the top gainers for the past week. So effectively, we have got this private equity firm that will acquire a stake in its data center business. Maybe some of you might not even be aware that Singtel has got this regional data center business. But more importantly, with this acquisition, it will put a valuation to the regional data center business, which is then estimated to have an enterprise value of 5.5 billion Sing dollars. So for many of us, we might be familiar with Singtel because of maybe our mobile plans, because we went to the Singtel shop to buy our iPhone 15. But what many might not be aware of is that it wants to be growing its regional data center business as well. And this would effectively be in Singapore, Thailand, as well as Indonesia. In fact, they have actually stated that they want to grow their capacity from 60 megawatts to 155 megawatts by FY 2026. And apart from the current places that they operate in, they are also exploring opportunities in Malaysia as well as Vietnam. Okay, so effectively, investors have seen this as good news for Singtel stock. We see that if you look at the share price, it has effectively saw quite a big bounce over the past week, as investors are now starting to realize the value of its regional data center business. Okay, so one stock that has actually done well for the past week because of the corporate exercise that has taken place. Next, we have got Singapore Airlines, a name that we often get a lot of questions on. A lot of investors follow their monthly passenger traffic data to understand how the company is actually doing. So what was actually announced is that the main airline, SIA, as well as Scoot, if you compare the August data compared to the July data, then what we see is that the number of passengers actually carried came down slightly. And together with that, their load factor came down as well. Okay, so this is actually likewise mirroring what we see for the tourist arrivals into Singapore. If we look at the August data coming off slightly from the July data. So effectively, we have seen this continuous improving trend after COVID reopening. We reached a high in July, but in August, we have started to see the number tapering off. And I think that is causing investors to have some concerns that the post-COVID reopening might be coming to an end in terms of the improvement. So we see that being reflected in Singapore Airlines stock as well. It effectively reached a high of close to $8 back in June. But since then, because the numbers have tapered off slightly, we see that effectively the share price has now come back to the $6.60 level. Okay, and the other key corporate development, we have got SingPost, effectively now raising the cost of local standard regular mail to 51 cents from 31 cents currently. And this will be effective from 9th October because the company believes that this will reflect the escalating cost of maintaining the postal service. So I went to take out their reported statements for the last fiscal year. And what you see here is that if I look at the postal segment, effectively it made an operating loss in the last fiscal year. And that is really driven by the fact that the revenues actually came down across both the international as well as the domestic postal business. If you look at the domestic business for the whole of the full year, effectively it came down by about 9.3% compared to the previous year. And with that, it effectively went into a full year loss across the entire postal business. So I think that is effectively what they meant by the escalating cost of maintaining the postal service because of the fact that the business has swung to a loss in the last fiscal year. So if you look at SingPost share price, what we see here is that with the announcement of the increase in the postal fees, it has a significant jump in the share price from about 48 cents now to above 50 cents per share. But even then, it's just back to where it was at the start of this year. In fact, it went to lows of about 42 cents in the middle of this year. And with the anticipation of this postal fee increase, with the company actually doing a strategic review, that has actually led to a bounce in its share price. So what to look out for in the week ahead? We have got quite a number of things that are happening since it's the last week of September. We have got the Corporate Connect organized by SIAS, and we are having a discussion with CapitaLand China Trust tomorrow on the 26th of September. For those who are looking at various bonds, the SSB applications for this month will close on 27th of September, and the T-bill auction will actually happen on the 28th of September. We're also tracking the US inflation data closely. So we have got the US PCE price index data up on the 29th of September that will give us a further indication of inflation trends in the US. So with that, I'll pass over to Sunny, who will share with us whether we are close to the near-term bottom and whether the technical indicators are telling us as to whether it is a buy signal. Over to you, Sunny.
Okay, thanks Gerald for the insightful sharing. A little bit painful on the sharing this morning. Interest rate going higher. Looks like in looking ahead in the next few months, our mortgage rate is not coming down, or maybe it will be staying at this high elevated level. So a bit painful there. So I think Gerald shared the probabilities of where the interest rate might be. So we are looking at we are not looking, or the market, the probability now that the CME Fed Watch 2 is saying that there might be no rate hike for this year. But if you look at the dot plot chart, okay, which is the projection, the FOMC participant consensus is slightly above the 5.5. So there's a chance that we might see another 25 basis point hike this year. So this is something that the markets need to reconcile against what the consensus of the FOMC Fed officials are right now. So I think there is definitely more volatility ahead going into the end of the year. But let's look at the charts, which will give us some kind of direction. So you can see this is the STI chart. For the last 5 trading days, it's been a very negative week. We have more or less gave back whatever we gained last week on the STI index. Of course, this is on the backdrop of the head and shoulder bearish kind of a chart formation forming, and hence the pullback wasn't really a surprise after we saw the formation of the right shoulder. However, is this the time yet? Is this the near bottom yet? I would think that there would still be a little bit more downside to go. I have shared earlier, the first support I'm looking at is somewhere at the low of end of May or early June. That is around the 3,155 points level for the STI index. I believe that would be the first support that will come in for the STI. Okay, why is that so? Because first thing first, the MACD indicator, as you can see after last week, not only have the MACD histogram shows the slowdown of the momentum that we saw previously, we have also seen the MACD line cross below the signal line, which is a bearish signal to say that the downtrend might actually accelerate downwards, or there might be negative momentum in the STI index right now. So this is a negative sign. That's why I'm saying now maybe it's not a time yet. We still got a bit more to go, about another 50 points to reach the 3,155 level before we start to look at whether there could be a stronger support coming in for the STI index. The RSI has also slid down from the 15th September high of 63. Now the latest one that we have today is a 43. So it has crossed below the 50-point neutral mark, which means that the uptrend signal is very weak right now. And we have not come close to the 30-point oversold level yet. So that means that we may not be able to see a rebound soon, because as you have observed previously on 21st August, when the RSI hits the 29-point mark, which is 1 point below the 30-point oversold mark, then we have a rebound happening. So I'm waiting for that to happen, for the RSI to hit the 30-point oversold mark before thinking about getting back into the STI index. So just be a bit more patient, and for the STI to sort of consolidate a bit further around between the 3,200 and 3,150, somewhere around here, you might be able to find opportunity to get back into the STI index. Okay, Hang Seng Index. So we can see on Friday, there was a big green candle. This is on one of the data that was showing on the Stock Connect that shows the highest amount of foreign inflows into China stocks via the Stock Connect connection. So this is an indication that a lot of institutions are looking at China stocks hitting a bottom already, and value are starting to emerge. And this is on top of some of the better than expected Chinese economic data that was published recently. So if you look at this level that it bounced on Friday, that was around the low of 17,570 points, which is also around the low that we observed somewhere in the 21st of August. So if this level were to hold, then it would have created a double bottom for the Hang Seng Index. However, as you observe, since the beginning of the year, Hang Seng Index has been on a downtrend for the longest period of time. So this, even though we may have a rebound, it may be a technical rebound, and then the primary trend is still against the Hang Seng Index, and it's still on a downtrend. So where could the next resistance level be? Of course, The next one, we'll be looking at the blue color line, which is the 50 days moving average. That's around the 18,500 level. And slightly above that, the upper bound of the Bollinger Band at 18,700 will be the next two resistance levels that we will be watching. So we have around maybe another 500 or 600 points upward kind of a movement before we hit some kind of a steep resistance over there. MACD is below the zero baseline, and as you can see, for the past at least 10 trading days, it has been sort of a sideways moving kind of a formation, so not telling you any kind of direction. Hence, cannot derive anything from the MACD indicator. So probably it's neutral, and then at this level now we are looking at some kind of consolidation happening before we see a bounce back up. The RSI is also on the weaker side. It's below the 50-point neutral mark. And although we saw a bounce on Thursday and Friday from the low of 36, the current reading of 42, it is in a territory where it is not oversold yet and it has a weak momentum. So a very weak kind of signal, but of course, this is something that we also see confirming what the MACD indicator is saying, that probably we are going to a phase of consolidation, and maybe we are waiting for some kind of further stimulus from the Chinese government to let the stock index go back up again. So this is a neutral kind of reading. At this point, Hang Seng Index is in a neutral zone or in a consolidation mode between the low of 17,500 and the higher 20-day moving average now, which is the short-term range that we are looking at 18,200 points level before we test the resistance at the 50 days MA and the upper bound of the Bollinger Band at 18,500 and 700 respectively. Okay, so just now we have the big numbers on the US indices, which Gerald shared with us. So you can see most of the US indices is a negative, so a very tough week for the US index. So we also saw the retracement of the Dow Jones index since the peak that we saw in the end of July. And we have the latest reading now at the 33,963 point, which is below the 34,000 candle, something that is very closely watched by a lot of technical traders. So this is a bearish sign itself on the Dow Jones index. And we are coming close to a very prominent support line, which is the red line, which is the 200 days moving average. This is the EMA line that I'm looking at. So this is slightly higher than the normal 200 days moving average. So it's around the level of 33,900 points now. And just slightly below this level at 33,700, we have sort of a support coming in during the June period, as you can see over here. And maybe a mini double bottom kind of formation, which pushed the Dow Jones index higher. So even if the Dow Jones has invalidated the long-term uptrend, it may move into a sideways kind of direction, and the support could come in around 33,700, which could be around the 200 days simple moving average. And thereby you can get in, even if it's just for a range bound trade, to let it go back up above the 20 days moving average at 34,500, or even the upper bound of the Bollinger Band at 35,000. So that gives you some kind of range to play with that for the Dow Jones index. Indicators are not looking that positive yet, hence that's also why I say that now is not the time to get in yet. Probably 33,700, the mini double bottom here, would be a more ideal position, because the MACD looks like it's diverging away from the signal line and crossing the zero baseline, going downwards. That means that the downwards momentum is still pretty strong. The RSI has a very steep slide since the 14th of September, reading at 55. Now it's reading at 35, so a 20 points drop within a few days. And that means that the downward momentum is actually very strong, and we are 5 points away from the oversold mark. So it's not really a time to get in right now, according to the RSI indicator. The previous rally that we observed somewhere around here on the March period, we saw that the RSI go to the 31-point level, and then market have a very strong rally upwards. So I'm looking at this primary uptrend to continue, but I need RSI to hit the 30 or 31-point kind of oversold level before I consider getting back in, and that could happen around the 33,700 points level for the Dow Jones index. Next, the next two big US index, both the S&P 500 and the Nasdaq Composite Index, actually suffered 3 consecutive weeks of losses, and this is one of the worst week that we observed since the March of this year. Okay, so a very big steep drop down, and also there was a gap down also. There is a very kind of bearish kind of sentiment and very strong sellers present in the past week. So we closed around the 4,320 points level for the S&P 500. Similarly, the next support that will come in is the red line, the 200 days moving average, and that would be around the level of 4,260 points. And just below that, we have a triple top formation on the S&P 500 index, which could have a change in polarity to become a support level for the S&P 500 to push up further on the primary trend. So I'm looking at the support coming in between the 200 days moving average, 4,260 to the 4,195, or I will just round it off around the 4,200 would be a good point that I'm looking at. And that could also be on this green line over here, the longer term uptrend line, which could be more sustainable. Hence, 4,200 is something that I'm looking at for the S&P 500 for a bounce to happen. And of course, when S&P 500 touch this level, I will relook at the indicators again. But as of now, the MACD indicator is negative and looks to be sliding downwards further. The divergence between the MACD line and the signal line is getting further away from each other, thereby telling us that there might be extended downward pressure on the S&P 500 index. The RSI is close to the 30-point oversold level, but not there yet. So I want it to cross below the 30-point mark before I start considering getting back into the S&P 500. I think that could probably happen soon in the next couple of weeks. So do look out for that. This is the first sign that needs to happen for the S&P 500 to get into the oversold level on the RSI below 30-point mark. And then we could see whether the MACD has sort of a reduced kind of bearish momentum. That means the MACD histogram that you see here starts to get shorter and shorter towards the upside, and thereby signaling to us that the downwards momentum might be subsiding, and hence it will be likely a good time to enter the S&P 500 around the 4,200 points level, which is about 120 points away from where we closed last Friday. Next, let's move to the tax-heavy Nasdaq Composite Index. So Nasdaq Composite Index, both on Thursday and Friday, seems to be hovering around this support that we have, which is the 13,181 points level, which is the low that we saw on the 18th of August. So if this level were to hold for this week, then it would have created a double bottom, and then the range that we see here since the June period would probably still be in play. So I'm looking very closely at this level, the 13,180 points, if it can hold. If not, then the next support level will be the 200 days moving average, which is just below the 13,000 handle at 12,900 points. So this is the next critical support I'm looking at for the Nasdaq Composite Index. Okay, so the MACD indicator, as you can see, is a very red right now. So very heavy kind of a downtrend momentum, downwards momentum have observed in the Nasdaq Composite Index. So probably, I think it will probably breach this one, but it just maybe could be a touch and go kind of thing, and we see a very steep rebound back up. So the 13,000 handle is something that I'm looking at very closely, which is also on the longer term uptrend line, the green line that you see over here. This could also provide further support for the Nasdaq Composite Index. The RSI is now reading at 33, coming down from a high of 1st September reading of 58. So we are 3 points away from the oversold level, and if that happens, that will give me the first alert for that will trigger for the Nasdaq Composite Index to say that we can go back in or start to look at going back into the Nasdaq Composite Index. And then the next one, I would want a confirmation from the MACD to show that the MACD histogram bar is actually subsiding in the negative momentum, like what you observe over here, the pink color bars. And if that happens, then I have a double confirmation kind of a signal to tell me that yes, it may be a good time that the Nasdaq Composite downward momentum is subsiding already, and if the 200-day support at 12,900 or the 13,000 handle might be in play or create a very strong support for the Nasdaq Composite Index to at least go into a range bound kind of formation to hit back the year-to-date high around the 14,400 level. So that is the sharing I have today on the technical side of things. Any points to add, Gerald?
So it seems like we are still awaiting confirmation for the market being a near-term bottom.
According to the technical indicators, yes, we are still waiting for that trigger to happen.
Okay, so I guess we have to await your update again next week to see whether we have seen a bottom in the market.
Yes, so looking forward to that. And in the meantime, we just want to caution traders, market is looking very red right now. So do trade with caution. And we'll see you again next week at the same time, same place in the next weekly market review.